a lot of employees might not be really understanding of what could impact a private company, because every year you get one valuation, if that, for a lot of staff. They won't even know about it.
Right.
You know, and they're just price takers in every sense of the word.
Right. I guess the other thing too there is, like, if you're a company, like, what do the docs look like when they offer these employee liquidity programs? Because, you know, do you have an employee who says, oh, great, I'm going to participate in this. I'm going to blow out 90% of my equity and I'm going to leave and go work at Apple, right?
Right.
So are they signing? Is there lockups around it? Like, I don't know. I haven't seen the docs, but I'm sure there are certain provisions that, you know, if you sell a certain percent, you're going to have to stay with the company for, you know,
stick around
time period.
And it's a retention tool.
Yeah. I mean, look, for me, this concept of a shadow stock market, like this type of stuff, when I see this stuff that happened with Stripe, it's almost like becoming institutionalized, right? Like if a certain number of companies keep doing this, and I was telling Don yesterday, I was reading a couple like white papers from law firms that like they're starting to recommend that when companies put together their employee stock options programs, like when they start the company, that they include language like this that allows them to do these things, right? So if this becomes something that's consistent and out there, we're going to have a shadow stock market. And then if you're an investor, like a financial advisor, I think you got to have exposure. You know, prior to like 10 years ago, you'd get these companies in the Russell 2000, you'd live with them all the way up. Now they're going to stay private until they're in like the top 50, and then they're going. You missed the whole run up.
Yeah.
Right? I mean, like Clint, you're like an allocator, right? Like, how do you think about something like that?
No, I think you have to have exposure, right? I think you have to have exposure here. The math speaks for itself, and I think as these companies get larger and larger, you're going to have demand continue to increase.
All right, here we go. 1, 2, 3. Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast with me, Nick Fusco, CEO, 8View, a pre-IPO secondary market pricing company, Don Nitti, venture partner at Social Leverage, a venture capital fund, and Clint Sorenson, chief investment officer at WellShield, an outsourced CIO and investment research company. We got 3 topics to hit today. Stripe's raising a $3 billion round. Pre-IPO stocks are lagging public internet stocks, and a relationship between valuation resets and layoffs to long-term pre-IPO stock performance. Okay, let's hit this first topic here. We're going to talk Stripe, okay? So we got Stripe is raising a $3 billion round. Looks like it's going to go at $55 billion to $60 billion. They got a ton of revenue, $14 billion in revenue in 22. I don't have profit margin for 22, but 21's profit margin was 20.7%. So they don't need the cash. So the rumor that's out there, and everybody's writing about this in the press, is they're doing this to take care of their employees, right? These guys have stock. They need to get liquid. Just to hit on the stock performance here, this stuff's from 8View, right? Our boy Nitti. So they're down 72% over the last year in the secondary. They did $63 billion 409A in January. So this $55 to $60 billion valuation here this month isn't so crazy. And then last, I want to talk to you guys about this employee liquidity program, right? And that's what folks have been calling this thing that Stripe's doing right now, employee liquidity program, and kind of how that resonates across the board, right? So, so Nick, why don't we start with you, man? What are you seeing for brokers out there regarding these like employees needing to sell stock to avoid kind of this stock option term? Are you seeing other companies out there with this stuff? Are you hearing it from the brokers? Like, what's kind of the pulse out there that you got on these types of deals that Stripe's entering into right now?
Sure. As a general sense, the last 3 months we've had a decent pickup on volume. So when you're just looking at both the bid and the offer side, I think the market's gravitating away from very much an offer side market over the summer and in Q3 to bids coming back, which is great. Like, we do want to see that. But
how are the spreads? Are the spreads good? The bid-ask spreads, they tightening up or still pretty far apart?
I would say from what we're seeing, they are tightening up, which is great for I think both sides. You're just going to get more trades out of that. You're more volume, and it kind of brings good. I don't know, some sort of good foundation in this market that was so rough over the last 9 to 12 months. So we're happy to see that. But also on the liquidity side, I almost look at it as a separate discussion. We've had a lot of inbounds from us just from from companies that want to either help facilitate or just be a part of the price discovery process on the liquidity component, because it is really important for employee retention. If I know we're going to touch on the big layoffs and things of that nature, but interestingly, I came from a company that did a liquidity event every year for almost a decade while they were public, or private rather. So I think this was a brilliant trend to keep staff engaged, not have them staring at Yahoo Finance all day, looking at a share price if they're public, so it's a good trade-off in my view.
Okay, so Clint, then that kind of begs the question, if this is going to become more prevalent, right? These like liquidity opportunities, like SpaceX does this every 6 months. They do it in June and December for their employees. So like, is there like a shadow stock market out there, or are we kind of moving into that space where it's like this proper shadow stock market?
Yes, democratization through and through, right? I mean, we see it in pretty much everything as it relates to access. Not to get on a crypto tangent, but essentially that's the idea behind crypto, right? Is it open, especially NFTs and all that. It opens up assets that typically wouldn't trade and have liquidity. It opens them up to a marketplace, right? It opens up data to a marketplace. And I think you're seeing the same thing across the board. And I think this trend's going to continue. Access is going to continue to broaden out. Thank goodness for people like 8View over there providing data, which is gold in this area, right? Because at the end of the day, you have to have that price transparency. But yeah, I think there's a shadow market. I think it's going to get bigger, and it's exciting.
Yeah, how do you guys think that's going to go? Sorry, Don.
Like, if you think about historically, like, there's been employee liquidity programs, but most of it's always been done alongside a primary round. So if the company was raising, they would go back and say, okay, we're going to do 80% primary, same way an IPO works, right? 80% primary, 20% secondary. And, if you're employee number 175, 200, you're really not, it's more of a C-suite conversation of what's happening. You're not really in the know of, when is that primary round coming? You obviously hear whispers around the office, but, I think now with a lot of these companies, they're being more transparent to employees because, in the past it was, okay, you want to sell, go sell. You got to find the buyer. You're going to have to set the price. You're going to have to, go through the process, submit the ROFR and et cetera, where, that's a stressful task for a lot of employees to go through, and they're getting inbounds from bigger funds. Where now, the company orchestrating this and helping employees get liquidity along the way in the lifespan of the company, especially if you've been there for X amount of years.
Right. But listen, Don, that's the thing. Like, some of these companies are staying private for longer now. So, I mean, like, do you see this trend sticking where it's not like 80% primary, 20% for the employees? Like, it's going to be the whole round.
Well, they're like massive Stripe now, too.
Well, if
like Stripe doesn't need the cash, right?
That's the thing. If the company doesn't need the cash, fine. If the company needs the money, they're not going to be like, oh, let's keep John Smith happy in ops. They're going to be like, we need money to pay John Smith, right?
Well, you also had the interesting anomaly last year with Bolt, where the founder came through and said, you know what, for the employees that have unvested stock, we can let you vest early. I think it was, and then a lot of employees were able to buy, and then the stock plummeted. So you got some really interesting things where you almost suspect that it's being done the right way for the right motivation, but a lot of employees might not be really understanding of what could impact a private company, because every year you get one valuation, if that, for a lot of staff. They won't even know about it.
Right.
And they're just price takers in every sense of the word.
Right. I guess the other thing too there is, like, if you're a company, like, what do the docs look like when they offer these employee liquidity programs? Because, do you have an employee who says, oh, great, I'm going to participate in this. I'm going to blow out 90% of my equity and I'm going to leave and go work at Apple, right?
Right.
So are they signing? Is there lockups around it? Like, I don't know. I haven't seen the docs, but I'm sure there's certain provisions that, if you sell a certain percent, you're going to have to stay with the company for,
stick around
time period.
And it makes sense as a retention tool.
Yeah. I mean, look, for me, this concept of a shadow stock market, like this type of stuff, when I see this stuff that happened with Stripe, it's almost like becoming institutionalized, right? Like, if a certain number of companies keep doing this, and I was telling Don yesterday, I was reading a couple like white papers from law firms that, like, they're starting to recommend that when companies put together their employee stock options programs, like when they start the company, that they include language like this that allows them to do these things, right? So if this becomes something that's consistent and out there, we're going to have a shadow stock market. And then if you're an investor, like a financial advisor, I think you got to have exposure. Prior to like 10 years ago, you'd get these companies in the Russell 2000, you'd live with them all the way up. Now they're going to stay private until they're in like the top 50, and then they're going. You missed the whole run up.
Yeah.
Right? I mean, like Clint, you're like an allocator, right? Like, how do you think about something like that?
No, I think you have to have exposure, right? I think you have to have exposure here. The math speaks for itself, and I think as these companies get larger and larger, you're going to have demand continue to increase. And if you start to think about the structural imbalances we have as from an employment perspective, 7 million men getting out of the labor force participation almost at lows in terms of at least the recent 20, 30-year period. You start to think about these structural imbalances, the great resignation, all that. You're going to have to continue to sweeten the deal and offer up supply to meet the demand. So I think this is going to continue to grow. I think access is going to continue to broaden out the private assets across the board, including private companies. And I think that's a great thing.
All right. Look, okay, let's shift gears here. Let's talk pre-IPO stocks versus public stocks. So, boys, it has been not great beginning of the year for
ODTE
stocks.
is all I'm going to say there, Aaron.
ODTE. What's that?
1 day till expiration options. Like if you look at what's going on in the public market, you've had this kind of resurgence. You had a lot of hedging, you had a lot of positioning coming into the end of the year. Now, when you look at that positioning, everyone was kind of positioned for this type of rally to occur, right? And people are off sides. So I don't put too much weight in the fact that the internet index is up a lot. If you look at, there's been a huge rally in trash, and I'm not going to dismiss that we haven't seen improvement, and that's not a great thing. But at the end of the day, I still think that pre-IPO equities offer up a significant opportunity relative to public assets. I just think you're seeing one of those unique times where positioning and a lot of other things, volatility characteristics have kind of played into, stock prices moving higher.
Right.
Well, I think
even
one
that
thing
term
around
though,
that.
Right.
Yeah.
Okay. So Nick, so go ahead, boys. Go ahead.
Yeah, I just want to bring up that term. We use it a lot in my office, but the pre-IPO, should we still be using that? Because I think Aaron already touched on it a few times. I mean, it's whether you want to call it a shadow market or just the proper secondary market, it's an OTC asset class in my mind, right? Is it pre-IPO if it won't necessarily IPO ever? I think if you have sufficient liquidity, you have these programs that are not necessarily driven by what Don was saying, a combination of a primary and secondary exchange occurring in the same event. Should we use that term anymore?
Okay, so Nick, that's interesting, but you got these big institutional venture capital firms, like they're gonna have to get out at some point. I mean, if the secondary market gets so active, right, where you're like swinging $100 million, $200 million tickets back and forth in the private market, then I get it, But I mean, are we seeing that? Is that happening?
It doesn't even have. We've seen $1 billion bid offer months for single stocks, right? From our perspective. So yeah, that's happening. But where my head is at is you don't necessarily even need it to occur in the secondary market per se. You could just have a natural progression to more institutional asset manager 40X fund styled holders at a later date. So when you start moving away from the VCs, then it goes into the big KKRs, Blackstones of the world, and then they offload it to a pension fund, or it gets landed into a T. Rowe Price or a 40X fund. Why does T. Rowe or Fidelity need it to go public? They could still market.
Yeah. Understood.
And that's the idea on that.
Stripe's doing they're talking about direct listing, so no IP. So to your point around pre-IPO, maybe that's too specific. I mean, there's all these different opportunities now on how do you kind of go public, right?
I'm sure Goldman will figure out a way to make money somewhere along the process. But thinking about, AG, to go back to the chart, and it's like the underperformance of, private companies versus public. I think one big component to that as well is that the natural buyer of this stuff got sucked out, right? Tiger went in and said, we're going to buy everything under the sun and we're going to index this, right? So they're getting creamed in the public markets. I think D1 and Co2's long duration growth was down like 60 to 70% last year.
Yeah.
So there's no more natural buyer of this asset class. You're seeing people now, volume picking up a bit, but it's more opportunistic at prices that are pretty distressed. So, but like that focus, it's a $1 to $3 million check from a family office. It's not someone coming in and writing a $50 to $100 million ticket in a secondary. So I think transaction amount will go up. Notional value is going to stay down from the prior years. But, I don't know. I think you have a lot of bag holders in this stuff too as well, right? So, it's going to be interesting.
Yeah, and Don, another point to that is the type of transactions happening in the public market. The percentage of retail participation is higher than it was in 2021. It's like we just went right back to 2021 from a retail perspective. And if you're looking at that, and to your point, institutional buyers recognize where we are in the cycle. Right? They understand we're in a growth and inflation environment. The Fed's still tightening into that. There's a lot of unknowns and uncertainty out there, and they're not going to be willing to just jump out and chase here on these private companies.
Yeah,
you're running a crossover fund. Do you buy Facebook at $100, or do you go out and say, "Oh, I'm dying to buy Stripe at a $60 billion valuation"?
That's very smart.
That's a liquid, and I got to pray that someone else is on the other side of it. You're getting into a mega cap tech, publicly traded company you could blow out of in 2 days.
Yep. Yeah, very good point.
Liquidity preference.
Okay, so maybe that's a perfect transition into this next topic here, right? We've seen some pretty dramatic layoffs in tech, and I know these are all big publicly traded companies, right? But I think we've all heard some of the similar type trends in the private space, the startup space, and these names here in the private, the pre-IPO space, right, or the private market space, have come down a lot, right? So these are based off of data from Nick, and then their kind of last primary financing round. These are the changes that I've calculated. So some 409A, et cetera, some mostly secondaries, right? But it kind of begs the question. This is what I want to get your guys' opinion on. With these layoffs that are happening. And the valuation resets, right? Don, for early stage companies, right, that you're investing into, is expense management now something that you're really looking hard at, right?
Well, I think there's two ways to look at this. There is early stage companies who have really high burn that were chasing the growth carrot, and that they're going to end up having difficulty going out and raising a Series B round, given what their A might have been priced at, right? Because you're looking at public market comps and you said, okay, well, we invested, the A was priced at 12 times sales and the median public market comp now is 7 times. So if they didn't achieve that revenue number, there's obviously a down round coming. So what do you need to do to reduce burn? And, is that go off and lay off 30 people or 30% of the workforce, whatever it may be. I think when you look at something like Meta and you look at their, 11,000 or 12,000 layoffs, it's much different because they're just making a behemoth at scale more efficient. But the other big thing, when you look at Meta's layoffs, they didn't just say, here's 11,000 people, we don't need them. It was, a lot of people that they cut was a functionality. And I talk about this, how, Apple essentially caused inflation, because when you look at the pre and post IDFA world and privacy change, a lot of those layoffs at Meta came from, a lot of more customer service reps that were dealing on the advertising side, account managers that were working with direct to consumer companies that were running targeted ads on Facebook, which no longer even works to acquire customers, right? So why do you have them sitting there if the product's not generating the revenue that it did in the past, right? So it's kind of like an apples to oranges layoff situation when you think about it. It's like, are you doing it to extend runway for the company so you don't have to raise in the earlier stage?
So or your portfolio companies, are they hanging on to folks? Are they adjusting? Are they just not hiring new people? Like what's going on with your group?
Yeah, I think it's on a case by case basis, right? You see some companies that are hiring and, executing and doing really well. And then you always have companies where it's, hey, we don't need 9 salespeople to run this, or we don't need 10 devs to do this. And what's kind of your cash position? Okay, you have 13 months of runway left. let's try to extend that to 23 months of runway. By then you should achieve these growth numbers, and this is what a Series B will look like. So everything's really on a case-by-case basis.
Got it. All right. So Nick, you're running a business, right? How are you thinking about this? I mean, you guys are an earlier stage, so I don't think you overhired or anything and had to deal with some of these things that these other people are thinking about. But going forward, what's kind of the thought process for you all?
Yeah, I mean, this isn't really affecting us at our stage because we're just hiring who we can, right? So some of it will be to our benefit because it's flooding the market with a bit more talent. But I'm also just kind of curious what this talent is going to demand, right? Because if they are used to overinflated pay to some respects at a Meta or elsewhere, and I've got a couple friends that have been laid off. I'm like, I can't afford you anymore. I used to work with you at a reasonable rate. Then you got this bumper pay increase. One friend was 100%. And you can't then even go after them because they might just be resting on their laurels until they get the next big thing. So, I almost feel like, I don't know, I'm going to pass the buck to Clint on where these folks' heads are at because you always come up with the best stats just across the broader market.
Yeah, I mean, I think this is just a function of the cycle, just like everything else at the end of the day. I mean, when you start to see, this is a lagging indicator. I don't think we're anywhere close to through the layoffs. I mean, we're now starting to see the average work week, climbs to tad bit. We're starting to see, if you look at employment cost index, everything, you're starting to flatten out. And then non-farm payroll growth, that's down on a year-over-year basis relative to the previous year. So you're already seeing a slowdown there. That's like the most lagging of the lagged indicators. So I think we're in the early stages of what we're going to see from and we haven't even seen the housing or housing-related job losses, right? That could be 1 million to 1.5 million jobs. So I think this is just part of the cycle. I don't think it's just isolated to tech companies nor startups. I think this is just going to be part of the general cycle. I don't think it's going to be. I'm not talking about a cataclysmic unemployment rise either. I mean, maybe 5.76%-ish, maybe even lower, right? Who knows?
Yeah.
But, that's still meaningful, and I think that is going to. There's going to be a lot of great employees come to the market, but you're going to have to allow them, to Nick's point, to work through this anchoring mentality, where they're anchored to in a lot of cases a highly inflated number due to this great resignation and demand and all this kind of switching the light switch off post-COVID to switching it back on, having to hire, no one could find people. I mean, it was nuts. We had a complete frenzy. And pretty much anything where you can measure supply and demand and employment was victim to that as well. And so I think you're seeing that kind of settle out.
It was funny. Last night, AG, I was in a Uber ride home. And I was talking to the driver, and he goes, when I started working, minimum wage was $6.25, and I could save money. It's $16 now, and I can't save shit.
I mean, look, but the one thing I got to ask, when I talk to some founders, okay, I'm talking startup tech founders, right? Almost the metric that mattered was how much talent I can attract, right, to the company. And you hear a lot of people, and that Google's got this big fancy campus, Facebook's got the big fancy campus. It seems like now, after these layoffs, right? And also too, this thing that Musk did at Twitter, where he just blew away 3/4 of the company and it's still running fine, right? That there's this renewed focus on level of effort, productivity within tech specifically. And the reason, so one, that's a question for the group. But then second, I'm as an investor looking at these companies, the private ones that have kind of reset and thinking, all right, I don't know, Don, to your point earlier, are we going to get back to the valuation numbers that we were at before? But these things are like coiled spring now. They're better. They're more efficient. They're tightening things up. They're perhaps better stewards of the capital. Are we primed for a good run here, going forward?
I call this the profits over promises theme, guys. At the end of the day, we were in this promises. So that had to do with recruiting, getting talent acquisition, right? It was all about brand awareness and your marketplace, essentially your resonation within the marketplace. And that had a big thing to do with it. You were just saying, hey, I've got the biggest, the strongest, most talented workforce, and that's what I'm focused on. And that was part of that promises, what I'd call promises generation or era we've been in, where everybody's promising future growth, promising user growth, promising customer acquisition, promising talent acquisition. And now we're back to profits mattering. And so when you come to this profits over promises theme, yeah, you're running a more efficient business. It's going to be more attractive when that starts to be where the demand flows. But that's my only piece there.
I had a lunch yesterday with my friend Peter, and he built and successfully exited, his first company, and then went into, growth investing as a general partner. But he was just saying it's so crazy how, a lot of these founders are pulling, this is at a seed, Series A stage, $175,000 salaries or whatever it is. He goes, when I started my company, he goes, me and my core team lived together because we had no money, right? So it was 5 of us splitting this 4-bedroom apartment. And he said he was making at the time, I think it was like $55,000 or $60,000 a year salary. He goes, but the productivity was so great because we dwelled together. And then he's like, the weekends were break time. He said, but we'd go out to the local bar, we'd have some beers, and by like 9:30 we were bored. We would go back buzzed and like come up with these crazy ideas. So the work week was actually much longer because we would all sit there and convene and generate ideas and start working at 9:30 on a Saturday night that could go till 2 a.m. And it took them 3.5 or 4 years, and they ended up selling that business to LVMH. And he was like, dude, I went to the board for a salary increase, and they were like, what do you make now? 300,000? He's like, no, I make 55 grand a year. And they were like, oh yeah, you could get a bump. Like, it's just crazy stuff. But like, are those days going to come back? I guess is the question. Are people really going to say, not bootstrap, because it works for some businesses and it doesn't work for some others, but is that type of team building going to begin to occur? I hope it does.
Yeah, I think that's like capitalism at its finest. Go ahead, Nick. That's capitalism at its finest.
Exactly right, and that rolls back to the shakeup we had during COVID, and then the shakeup with the Great Resignation. These things kind of hitting back to back is incredible. Once you change your mindset and change what you're actually working towards, I mean, new ideas are just going to flourish. And I think with the mindset shakeup that you're getting with when these big firms are laying off, sometimes it's harder for the startups to go in and say, okay, let me try to compete because, you just got laid off from Deloitte or Meta. Like, you think you're safe here? Absolutely not. Yeah. But sometimes if you get your head in the right space, and Don, it sounds like Peter hit it perfectly with his pals and partners. If everyone can know that they're in the same boat and working towards the same goal and be incentivized with the equity, I find that we can compete very well against these big shops now. We're going to pay significantly less on the base side, but the upside potential and the percent share of ownership is just so attractive, right? So you kind of don't. I almost feel as though that middle sector of the middle tier companies, kind of the lower end of the S&P 500, are getting the bad shake here because you either want to work for the sexy startup or you want to work for the Google, at both ends.
Right. Yeah. Well, there's just, my opinion, there's an incredible opportunity. I feel bad for the folks that invested in 20 and 21. That was a rough place to get in to these, private company stocks, tech stocks. But now I think it's awesome. You got management's got their heads screwed on straight. You got an employee base that I think is starting to get it. And these companies are still growing high triple digits a year. I mean, it's like, it's primed. It's primed for I think a healthy pop. So, but there's just so many interesting market dynamics with this employee, tender offers, employee liquidity programs, with staying private longer, with all of it. It's really interesting how it's shaking out. So, all right, boys, let's call it there. That was a good day today. Come on.
Yeah, it was fun.
Anything else? I know Don's buying watches. What about the rest of you? Ferraris for Clint, right? What else?
No, I'm not a car guy. I got a big old truck, man. I live in the South.
I know. Nick and I are like, if we do a proper black car, that's like a luxury for us, right? Here in the city.
This is black, and you
no. You got it, baby. You got it.
I upgrade my ride. I go from a regular city bike to one with the electric juice on it now. So
that's hot.
There you go.
I'm living large.
Good. All right, gentlemen. I appreciate you. You guys have a good week. Okay.
See you
later.
Good night.
Take care.